Good afternoon, everyone, and thanks for joining us for today's webinar, ASC 842 Leases, Moving Forward and Implementation. I'm Dan Sturm, partner with McConnelly & Asbury. For those of you who don't know, McConnelly & Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg. We provide a range of services to organizations across a variety of industries, as you can see on the screen. We encourage you to visit our website to learn more. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. With COVID, we added to our monthly lineup to bring you additional content on the ever-changing regulations, including the Paycheck Protection Program and an Employee Retention Tax Credit. So be sure to check out our website to catch past presentations as well as current information throughout our blog. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during the live Q&A towards the end or after the webinar. We also plan to address any questions submitted during the registration at this time as well. For those of you who are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 3 polling questions throughout today's presentation, and you will need to answer all 3 of those questions to get your certificate via email a few weeks after the webinar. Before we dive into today's content, let me take a few minutes to introduce you to our team. With us today, I'm Dan Sturm. We also have Brett and Tim, also with McConnelly & Asbury, and Jason joining us from simpLEASE. Course objectives, we want to show you some illustrative financial statements. We also want to help you gain an understanding of what you should be doing now to prepare. Hopefully, for those of you that joined us, I did see a lot of familiar names on the list. I think you've joined us for previous webinars as well. So hopefully you've already got that preparation underway. But if you've got that preparation underway, you still have some questions, hopefully we're able to help you out through this webinar. We're also going to give you an introduction to simpLEASE, and Jason will take that on. So about 20 minutes to half an hour towards the end of the presentation, Jason's going to give you some screenshots and some information on simpLEASE, which is a great resource that we've come along that should help you with your implementation of lease accounting. As far as the status of the new standard, it's effective for probably most of the folks on this call. As I look down the list, mostly non-public entities that are joining us on this call for periods beginning after December 15th, 2021. So essentially January 1st, 2022. Second point here, we've been talking about leases probably for about 10 years now and this standard, and it's coming, it's not coming, it's delayed, it's not delayed. I think COVID gave us another year to get on board with lease accounting. But I do believe it's here to stay at this point. Public companies are already implementing it, so I don't see that changing for private. So I do not see any further extensions. And with that, we're going to get started with our first polling question. And this is just for us. We just want to get some kind of idea from the audience of just a general consensus. How many leases does your business have? Options are less than 10, between 10 and 25. More than 25, or you're not sure. And we'll take about 40, 45 seconds to get some answers in here. And Jason, I know you deal with a lot of customers as you implement simpLEASE. If you were to ask this question probably at the beginning of the project, does the number often change as you get through the end of the project of bringing people on board?
Yeah, Dan, it's a good question. One of the things that we find, and the term that I like to use when we're doing implementations, is shaking the tree. So somebody will come to us and say they're interested in the software, and they have 10 leases or they have 1,000 leases. And when we're done with our process, they have 1,008 leases or they have 15 leases, because there's always something more, especially when you start to consider the various aspects of what's considered a lease under 842. So there's always more than you think. There's always a few hiding in the background somewhere.
Yeah, sure. I don't think that surprises me. And we have a pretty mixed results from the poll, but it looks like a majority on this call believe they have less than 10. Based on what Jason said, you probably end up between in that 10 to 25 bucket when all is said and done. So I appreciate the responses. And with that, I believe we're turning the presentation over to Tim to give you some examples of what the disclosures and the financial statements will look like. Take it away, Tim.
Great. Thanks, Dan. So I just want to spend the next few minutes here discussing implementation considerations. So as Dan mentioned, we're coming up on the effective date for this. It's finally here. It's been delayed several times. So with an effective date of January 1st, 2022, we're talking about 7 months now between now and then. So if you haven't gotten started, this is definitely the time to do it. So this first slide here just paints a picture of what types of changes are entailed in the new standard. So the slide deck should have went out to all registrants this morning. If you didn't receive it, please feel free to just reach out in the chat bar and ask for it. But feel free to use this slide. This is really designed to be a resource for you if you'd like to use it, just to give you that snapshot of what the changes are and what type of impact the new standard is going to have on your financials once it's implemented. If I were to distill the standard into 3 basic takeaways, it would be these. One, capital leases got a name change. So what was once capital, it's finance leases now, and nothing much has really changed beyond that for those. Second takeaway is that operating leases are now going on to the balance sheet. And then the third takeaway would be that the footnotes got longer. So the measurement of operating lease assets and liabilities and preparing for those additional disclosures are really where the challenges are going to arise, and really the time commitments are going to arise as you go about preparing for this. Right. So as you're thinking about how you're going to go about implementing this on your financials, keep these options in mind. There's really 2 options for implementation when you get down to it. The first option is the retrospective method. So what that will entail is, so for 2022, when you go to do your financial statements for the year, and that's the current period in which it's effective, under the retrospective method, you're actually going to go back and restate the comparative period. So you're going to go back to 1/1/21. You're going to do your initial measurement of those new operating lease liabilities and assets, and then you're going to restate 2021 using the new guidance. And that would also entail putting together those disclosures, the new disclosures that are entailed in the standard. Option number 2, which is what we're seeing most companies do, and this is certainly would be our recommended method unless you have some compelling reason to do otherwise, is the alternative method. So just to walk through that, so with the effective date being 1/1/2022, you would go about doing your financial statements using the new guidance, and the 2021 numbers that you're presenting for comparative purposes, those wouldn't change at all. So those would still be presented under the old guidance. No need to go back and say, okay, what would these numbers have been if the new standard had been effective back then? And also no need to go back and draft those disclosures either. So there's a lot of advantages to this way, and it's certainly what we would recommend. Right. Also want to discuss some things that can make life a little easier as you go about implementing the new standard. So there's a series of practical expedients. So these are optional, but they're designed to be time savers for you and your team. So the first one here that we want to talk about is discount rates. So the discount rate really comes into play when you're measuring those new lease assets and new lease liabilities that would be entailed with your operating lease agreements. So the discount rate comes into play because you'll need to measure the present value of your future rent payments when you're measuring those liabilities. And then your lease assets are going to come on the books at the amount of the liability plus or minus some other factors. So the discount rate is going to be a really key item here for any operating lease that you have once you come under the new guidance. So the key here is under the new guidance, what would be required under the typical guidance is for the lessee to use their incremental borrowing rate. So what that would mean is if you have a lease that goes 5 years and you're going to pay $100,000, it make $100,000 in rent payments over those 5 years. What that would mean is, in terms of your discount rate, you would say, okay, what would it cost me in terms of my interest rate if I were to borrow, take out a $100,000 loan over a 5-year term? What would my interest rate be on that if I took this out as debt? So that's what you would want to consider for that. Knowing that that can be sometimes difficult to attain that information or estimate that information for given how variable your lease terms and your payments can be, this practical expedient would say, well, instead of doing that, instead what you can do is use whatever the risk-free rate is at the time of the lease. So that would be looking at whatever the going rate is on U.S. Treasury bonds for a similar term to what your lease is, and going ahead and applying that. So certainly a time saver that will result in larger lease assets and liabilities coming on your books than if you just used your incremental borrowing rate, but certainly something to consider from a time saving standpoint. And one last thing that I would point out, this goes for this practical expedient as well as the others we'll get to on the next slide, is if you choose to do this, you do have to consistently apply it to all leases. So what this would mean is you can't use the U.S. Treasury rate for one lease and then go back and use your incremental borrowing rate for another and flip-flop back and forth. If you do choose this, you have to consistently apply it. Few other practical expedients. Each of these three are nice in that you can elect to forego what you would otherwise need to do under the standards. So this first one here is, so it's very common, if you have a property lease that you might have $1,000 a month going out the door to the lessor, but 700 of that might be specific to what you're actually paying to use the building, and 300 might be for CAM. So you can elect as a practical expedient not to have to sift through and determine and segregate those components. And you could instead just say, okay, for purposes of my future payments on my lease, and thus the payments that I'm using to calculate my assets and liabilities, I can just treat that as one payment. So my future payments in that scenario would be like the 300 CAM plus the 700 rent. And that way I'm saving time. I'm just using the $1,000 payment that's going out the door to measure my assets and liabilities. Second one there is probably the most popular and among the group of anything I'll show you in terms of practical expedients. And that's this option to essentially carve out your short-term leases from being applied to the new guidance. So if you have leases of 12 months or less that you're entering into, there's this nice carve out here in that you can choose not to have to put them on the balance sheet. It can be status quo. You can just, similar to the old guidance, what you're doing right now is as you make those payments, you're recording the rent for those short-term leases. So certainly a popular one. All right, and then the last practical expedient, just to keep in mind, is you can choose not to revisit the classification of leases when you go to, of existing leases when you go to implement this. So if you have a lease that's ongoing, you're right in the middle of it as of January 1st, 2022, when you go to apply the standard, you can, and you've already determined that it's a capital lease and thus now a finance lease under the name change. You don't have to go back and say, well, was this actually an operating lease? And the same goes in reverse. Operating leases, you don't have to say, well, was this actually a finance lease now? All right, so probably, certainly one of the biggest hurdles that we've seen with those who have gone through the adoption process, those that have implemented the new guidance, is just the process of determining what your new operating lease liabilities and assets are that need to come onto the balance sheet here on that first day, that effective date of January 1st, 2022. So there's just these next couple slides give us an example of a common situation that could happen. So there's the situation here in the example. So this company has this ongoing property lease, so they're right in the middle of it as of the effective date. So with a commencement date of 1/1/21, they're a year into it when the effective date of the guidance comes around. So the question is, okay, how do we go about putting this on the balance sheet? What do we need to do here? So first item to keep in mind here is, so this company here, their incremental borrowing rate is 6%, and that's what they've decided to use. Just keep in mind that they could have used the risk-free rate. And then they also have a deferred rent liability that they've booked under the previous guidance based on what the previous accounting would have had them do. So here's what would happen then. So given the scenario of that lease, with the timing of payments, the fact that they're 1 year into it, what they would need to do in terms of establishing the initial asset and liability associated with this is, first of all, they would record the liability based on the present value of the future rent payments on the lease. So what's left is they have $31,000 for 2022 and $33,000 a year for the remainder of the lease, discounted at 6%. So that's what would come on the books as a lease liability. They would have a right of use asset, a brand new right of use asset that would come on the books. And then the difference between what they're recording for the asset and liability is just that wiping off that deferred rent liability that was specific to the old guidance, but that no longer applies going forward. So that would be the initial entry and what that would look like. And the key there is 1/1/22, the rate that you're going to use is either your incremental borrowing rate as of that date or whatever the risk-free rate is as of that date in terms of measuring this the slew of ongoing operating leases that you have at that point that need to be recognized. Then just to carry this through to see what the ongoing accounting will look like. So we're coming to the end of the first year in which the lease guidance is effective. What does it look like in terms of the impact and in terms of what we're recognizing going forward? So, and just to put this in terms of an entry, we have the lease liability coming off the books for the portion that pertain to principal payments for the year. We're recognizing lease expense on a straight line basis. So the straight line basis for that based on the payments, escalating payments, that converts to $32,200. Amortization of the right of use asset for $25,452, which would be the difference between what our expense amount and what our interest expense was, specific expense was for the year. So A minus C there in our table. And then last, of course, we had the cash that actually went out the door that year, which is what the agreement called for, which was $31,000 in cash. So this just gives you a glimpse of what's happening behind the scenes here and the types of considerations that you would need to have. This, of course, is just a simplified example. In reality, there will be other considerations that you'll need to think through for any ongoing leases you have. In particular, if you have a lease that where you have the option to extend, you just have to think through, well, is it probable that I will exercise that option, in which case that would then factor into what you're recording for liabilities and assets. So a lot of considerations to think through. So that's why we definitely recommend that at this point, this is definitely the time, if you haven't started already, to really get your list of leases together and really start thinking through these types of things, and that'll be key to your implementation. So the actual entries and the gathering of the leases is the first challenge, and then the second challenge is just preparing for the new presentation and disclosure requirements. So again, we've listed the key items here on this slide, and then also some examples for you to look at just so you can visualize what things are going to look like here under the new standard. And just to reiterate, we've assumed use of the alternative method, so wherein you're not going to restate 2021 for each of these examples. So just keep that in mind, and we just encourage you to keep these slides as a reference here as you go to about implementation.
Hey, Tim, the one thing that jumps out at me as you go through some of these illustrations is we just got through implementations of ASC 606. And while we thought that had a pretty drastic impact, I don't think it had anywhere near the impact that leases are having. I mean, it's impacting the balance sheet, the income statement, debt covenants. I don't think we saw that as 606 was implemented.
Absolutely, Dan. Yeah, the impact of this is going to be so much more evident right off the bat than revenue was. That's for sure. And with that, I'm going to turn it over to Brett to go through some other considerations.
Great. Thanks, Tim. So I know some of you are on today's webinar because you're most concerned with the accounting for leases under the new standard. And so hearing the debits and credits that Tim just walked you through is most helpful to you. I want to take a few minutes though and talk to those of you on the webinar who maybe won't be in the weeds quite as much on this, but you want to know, what does this mean for your business? What is the impact beyond the debits and credits? And so I pulled out 3 different areas where I think your business will likely be impacted by the new lease standard. First, debt covenants, as Dan alluded to. Second, this is going to impact how every user of your financial statements interprets your financial results. And lastly, this will impact the comparability of your financial statements as you look to not only benchmark against other companies, but possibly look to mergers and acquisitions. You can go to the next slide. All right, so let's take a look at the first major impact to your business, and that is the impact of debt covenants. So there are a number of ratios we could look at here, but in this example, we're going to look at a pretty straightforward covenant calculation, which requires a current ratio of 1.3. So in this example, under the current lease standard, this company has $2 million of current assets. They have 1.25 million of current liabilities, and that brings their current ratio to 1.6. So they're passing under the current lease standard. Now, Tim, if you click, as they look to adopt the new lease standard under ASC 842, they have 1 operating lease requiring 5 annual payments of $500,000. Again, we're just really simplifying this illustration, but when they adopt ASC 842, they will be putting $2.5 million on their balance sheet. Now, something that is overlooked sometimes is the fact that the entire $2.5 million is going on your balance sheet as a non-current asset, as would any other PP&E. However, on the liability side, a piece of that next year's payments is going in the current liability bucket. So $500,000 increase to your current liabilities and no change to your current assets. Now you can see what that does is it dilutes your actual current ratio under the new standard to 1.14, which is no longer in compliance with your debt covenant. So the takeaway here is to look at your debt covenants and determine what impact, if any, the new lease standard is going to have on them. All right, the other main change that I mentioned on the first slide is that the new lease standard is going to impact comparability of your financial statements. And I'm thinking of this from two perspectives. There's how it's going to impact how you compare your financial statements internally as well as externally. So internally, just think of your board of directors, your owners, maybe your senior management team, who are used to tracking certain key metrics or ratios for your company. A lot of those ratios are going to be negatively impacted once you adopt the new lease standard. So you have to consider, will those users of the financial statements understand how to interpret the decline in those key ratios? Also, will they be able to understand how to compare prior period ratios to those ratios post ASC 842 adoption? Then on the flip side, externally, your financial statements may not be comparable to other companies or even industry averages, like I mentioned, around the period of adoption. And now Dan had mentioned this, it's important to remember public companies have adopted the standard several years ago. And some other companies, even private companies, had the option to elect early adoption on this standard. So be careful when you're benchmarking against other companies or industry trends, since you likely don't know whether those companies adopted the standard or not. And this certainly comes into play, as I mentioned, if you are one of the many companies looking into possible mergers and acquisitions. If that's you, make sure when you're looking at another company's financial statements that you understand whether or not they've adopted the lease standard yet, as that will have a significant impact, especially on the balance sheet. So our advice, the last bullet point there, is that you start preparing now for this change. Communicate to and educate your board and your key members of management so that they understand how this standard will impact key metrics that they are used to monitoring. Definitely don't wait for a drop in your return of assets to start having that conversation with your board. And then we'd also recommend talking to your banker or possibly your attorney to see if you need to amend any of your existing agreements. Again, you don't want to wait for a failed debt covenant to start looking into this. Next slide, Tim. I want to finish with a quick case study here, and actually put together results from 3 different airlines, and I want to compare changes in key financial ratios from 2017 to 2018 for American, Delta, and United. Now, in this table, the red highlighting, that just represents a relatively large decrease, so an unfavorable change in the ratio year over year. The yellow is a moderate decrease year over year, and the green highlight, that would be a moderate increase, so a favorable change in that ratio. So if all you're doing is looking at these static numbers here, you have no other context for this analysis, you're looking at these 3 airlines and you're probably going to conclude, something is going wrong with American, pretty bad trend there from 17 to 18. Possibly something is trending downward as well for Delta. But in reality, what you don't know just by looking at these numbers is that in 2018, both American and Delta chose to early adopt the new lease standard, whereas United did not adopt that until a subsequent year. So by removing the impact of ASC 842, you'll see here on the next slide what the apples to apples comparison would be. So Tim, if you can go back, I just want to show again the initial table, one more slide. If you're looking at those metrics under American and Delta, and then flip to the next slide, once you remove the impact of the lease standard, you can see pretty clearly for all 3 ratios, they only improved once you back out the impact of the new lease standard. So the message here is that financial statements and key ratios can be misleading if you don't know the context. And in this case, the new lease standard, and especially the timing of adoption, is a major part of understanding the context. And it looks like we're moving to the second polling question.
Yeah, no, thank you. I think that context, Brett, was really helpful just to see the impact of airlines in the same industry, or any business in the same industry, and the comparability, which I know you focused on in your presentation. So with that, one of the things that we're curious to know is, have you spoken to your bank yet? Some of the covenants that will be impacted are fairly common. We see that across a lot of our clients, and it's not surprising they will have a big impact. So we're just curious, have you spoken to your bank yet regarding the impact of the new standards? I think if we had another couple hours, I'd love to know what the results of those conversations are and what they're doing with covenants and things like that. But for this purpose, it's just a yes, no, or unsure if you've had those conversations. And we'll take a few seconds here to answer these.
Yeah, Dan, I actually was just talking with a local banker here and kind of asking him this question. And he said, well, he's had some discussions with clients and changed some covenant language. For the most part, he's getting the sense that companies have kind of shelved the whole new lease standard. They've had a lot going on, obviously, the last year. And so we'll see, hopefully, companies are being more proactive now as the economy is ramping back up.
Are did you get the sense the banks are waiting for their clients to reach out, or based on how you said that, it doesn't seem like the bank's being very proactive with it.
Yeah, as far as amending agreements, it sounded like they were more or less waiting for clients to reach out. There's some education going on at the banks to be prepared for it, but I think clients will be driving that.
And our results are in, and overwhelmingly, over half the results saying, no, we haven't talked to your bank. That would be a big recommendation on our part, is if there's anything you take away from this, if you believe your covenants are impacted, get in touch with your bank and make sure that you're addressing that now. You'd rather do that now than wait till year end or even come audit time, review time, and to be dealing with covenant failures and things like that. And with that, I'm going to shift it back to Tim for a quick slide with some takeaways from early adopters. And if we could advance to the next slide.
All right. Thanks, Dan. So just wanted to share some closing thoughts from the preparation side before we turn it over to Jason here. So some key takeaways here, just to recap. So based on our observations from early adopters, from what we've seen thus far, really does come down to the two biggest challenges that companies who've adopted have seen is, one, determining those initial values of those assets and liabilities that are going to come on the books for the first time related to operating leases. So measuring those has been challenge number one, and getting the info to do that, and then actually going through the calculations to do that. And then the other big challenge that we've seen is actually gathering and calculating the information needed for those new disclosures that are coming into play now as a result of the new guidance. So definitely common theme here that you've seen is now's the time. Now's the time to develop a plan for adoption because what we've seen is the trend is it's going to take more time than you would initially think to prepare for this because there's just a lot of things to think through. Another thing to keep in mind is consider applying a threshold to your leases when determining whether assets and liabilities need to be recognized. So be practical about it. I would analogize this to, when you set a threshold for fixed assets, regular fixed assets, it's very common to have a capitalization threshold under which you would not worry about putting things onto your fixed asset register. Consider doing that as well with leases. That can really weed out some of those things that just aren't significant, that you really don't need to think about from a materiality standpoint. All right, and then last key takeaway here, if you have more than just a few leases, you've seen what is involved in terms of determining the assets, liabilities, and disclosures. Consider a software or outsourcing solution for tracking and accounting, because there's just so much. If you're going to try to do this manually on your own, if you have more than just a few leases, there's just a lot that can get missed if you try to do it that way.
No, perfect, Tim. And I think with that, we're going to shift it over to Jason. I've seen demos of this product. I think a few in our firm have, as well as a few of our clients already. And it seems to solve a lot of the issues. So I know this is a fairly brief presentation for Jason as far as describing the product. If you're interested and have more questions for him, by all means, reach out after. But it seems to solve a lot of the issues that the clients might encounter as they go down this route.
So thanks, Dan. Appreciate you having me today. For some of you out in the crowd virtually today, I may have met you a couple years ago. We actually did a presentation, I think it was 2019 or maybe even 2018 at this point. But nonetheless, thanks for having me today. What we're going to talk about is simpLEASE. But before we get into that, I figured what we would do is take a couple minutes and talk about what we've learned. So over the course of the past 2.5, 3 years, we've been implementing software for clients of all sizes and helping them through onboarding leases under 842. And going through that, we've learned a thing or two over the years. So what I want to do is talk about some of the lessons that we've learned and some of the things that we can hand off to you to make you a little bit more prepared as you're getting ready to move through the oh so fun 842 process. So with that, I will say Tim was right on his last slide. come up with a plan for your adoption, because those that have not planned ultimately take longer and ultimately have more pitfalls. So the more you plan, the better off you are. The lessons we've learned though, number one, know your portfolio. So when you have the opportunity, get a full inventory of all of those things that you know are leases today. And along with just the leases, any data points that are critical around those assets that you're leasing from someone. When we go to do an implementation, we found a bunch of things that people weren't expecting. You know, we found leases that accounting had no idea existed. We have found with clients leases that there was no documentation for, or there was no proper amendment documentation. So there's all sorts of situations that we come across by going through this process of interview during an implementation, where people realize they weren't as prepared as they could have been, and it makes that whole process more difficult and more strung out. So go through and understand what leases you have, and make sure that you know as much detail about each of those leases as possible. Again, it'll just make this whole process much, much simpler for you. The second lesson we learned was, and I mean this in all honesty, really, know your leases. Most of them are fairly obvious, but there are contracts that you have that might qualify under 842 as a lease now, that might not be as obvious as you think they are. The other thing that you should think about are, what about my embedded leases? How do those come into play? What am I going to do with those? Does that change the aspect of how I lease things or not? What we see a lot of the time as we go out to new clients, whether they're new clients to the software or new clients to us in general, is that there's a lot of contracts out there that are hiding in accounting that are technically leases under 842, right? So cloud software is one that we see more and more people going to, especially because of what happened with COVID. More people are moving their email out into the cloud, and other services that people use, Microsoft Teams or GoToMeeting or those sorts of things, are very, very common. Do those qualify as leases under 842? So we have to think about those things. We don't typically think about those as leases, but under 842, they may qualify. So make sure you bring that up with whoever you're working with, so that you can account for it correctly upfront from the beginning. The big question is, do you have full control over the asset? And there are lots of questions, right? But this is one that we really need to press upon people, because they sit back and they say, well, I'm leasing a dumpster, right? I lease a dumpster for X number of months out of the year, or for X number of years in a row, I'm leasing the dumpster. Well, that may or may not qualify under 842 as a lease, because that dumpster company may be able to come in and swap out dumpsters in the middle of the year. You don't have full control over it. That means it doesn't qualify as a lease under 842. So it's more than just, do I have something that looks and reads like a lease agreement? It has to read like a lease agreement under 842, and there are some nuances there. So make sure you understand 842, but also make sure you understand your lease portfolio. One trick that we've learned, and we do this with all of our clients, is open up AP and look at reoccurring payments. If you're paying a vendor the same amount every month at about the same time, or once a quarter for about the same amount, you more than likely have a lease on your hands. So think about that as you're going through and looking through your portfolio and understanding that. Again, these things all help make moving to 842, whether you're doing it through software or not, much, much easier. Lesson number 3 is, you know what, maybe we haven't been doing lease accounting appropriately prior to 842, right? And one of the things that we run into most commonly with this is, how do you handle deferred rent? If you handled it correctly prior to 842, adopting 842 shouldn't have any impact on your earnings. But if you handled it incorrectly, well, now we have to make up for it, right? So this is the time it's going to be rectified. So be prepared. If things haven't been done correctly, or if they've been done sort of off kilter in the past, it's going to have to be made up for and caught up for now. So that's one of those things that you may not be expecting. You've gone through CPE like this for the last, as Dan mentioned, has it been the last 7 or 8 years, and you're saying, oh, I'm good, I understand all this. Oh, wait a second, my deferred rent is all off balance. I haven't been handling it exactly as I should. That's going to throw a wrench into the works. So keep that in mind as well. And then the final lesson is, FASB's delayed the standard by another year. And we think, and I'm sure the other folks on this end of the presentation today would agree with me that, this is due to COVID. The first one was due to the fact that it was taking public companies longer to adopt because of difficulties. There were some lessons that were learned in the industry during that adoption, right? But we think that this delay has been pushed mostly because of COVID, because of everything that's happened, the separation of your accounting firms and your accounting staff and whatnot. That being said, here where we're at in Pennsylvania, the governor just announced that the mask order has effectively been lifted for the better part of everybody. So things are going to change. We agree. There's no onset of another delay. This is the time to adopt. So be ready. There are those decisions that you're going to have to make. Are you going to take on the practical expedient? What are you going to use for your discount rate? These things, you want to put time and thought into them. So start thinking about them now so you have enough runway to get to the point where you're making a good decision so that by the time you adopt 842, you're all set. What we're seeing is companies, and it isn't all public companies, that we have a lot of clients that are smaller companies. We actually have a lot of nonprofits that have already adopted 842 for one reason or another. They found that it's more difficult than they thought it was going to be. And we've learned that it's more difficult than we thought it was going to be. So if you think it's a project that's going to take 3 weeks, it's going to take 2 months. If you think it's a project that's going to take 2 months, it's going to take 3.5 months. That's kind of our experience over time. So it can be done, and it can be done well. It's just going to take more, and it's more involved than you might think it is. These guys do a great job of explaining the intricacies of it. But when you sit back and start to look at your individual leases and start to realize what you have to do en masse with them, that's when we start to sit back and think, wow, this is harder. This is going to take more details. It's going to take more time. So be prepared for that. So with that, I believe we have a polling question, and then we'll get into a couple quick slides and then show you some software. So if we want to, I guess I have to do this, huh? To bring this one over. So here's our third polling question.
Yeah, thanks, Jason. Yeah, it's how do you plan to track and account for your leases under the new guidance? And again, this is as much for us as it is for the benefit of the audience. We're just very curious. Do you plan to use Excel? Have you already started evaluating software solutions? Or do you plan to outsource that, or you haven't decided at this point? So we'll take a few seconds here to get some responses in, and I'll be real curious of this response too as well. And I think, Jason, a couple of things you pointed out as our audience is answering questions here. It's one thing gathering the inventory, it's one thing getting everything in the software, but it doesn't stop there. The new leases don't stop coming on board. So it's the ongoing maintenance. It's the leases that get extended. So it's that ongoing tracking that maybe an Excel file gets a little bit cumbersome to manage as well. Then it ends up taking a whole lot more time that you don't honestly want to spend doing.
Yeah, and I think like you guys probably see, and we see this a lot, Excel is a great tool, but man, one crossed finger in Excel and, there goes your reporting. So you do have to be careful with how we use Excel. It's a great tool, but it's only so secure in a lot of ways. So
exactly. Yeah, and I mean, this is probably where I expected it to be, especially based on the counts of leases up in the beginning of the presentation. So a little less than half plan to use Excel, a little over 10% plan to use software, and we have a bunch of people that are undecided at this point. So with that, go ahead and finish up, Jason.
Well, let's try to change the undecided a little bit and give them a little more guidance as to how the technology can help out. So what we want to do is we want to talk through, can technology help out with this? Because, as the guys were starting off today, there's lots of things that we have to take into account, and there's lots of calculations. If you looked at what's going to be needed to be added to the disclosure for the financial statements, there's a lot of detail in there. So one of the questions a lot of people ask is, can technology take care of this for me? So what we like to say, regardless of who we're talking to, is there's 2 questions we can ask you to see if it's worth even your time to look at software, right? So those 2 questions would be, is my current accounting system already capable of doing this for me? Especially if you're using software that's out in the cloud, right? They may have built a module for you. So you do want to take advantage and look at that and see if they have something that can help you do 842. My guess is they don't, but it's worth looking at. The other question is, how many leases do you have? And not just how many leases do you have today, but how many leases could you foresee yourself having next year or the year after that, right? So what is your couple year down the road lease portfolio look like? Maybe you're expanding because of what COVID did. You're taking one big space and you're splitting it up into several smaller spaces, or whatever the case may be. How many leases are you going to have in the future? If your accounting system doesn't do 842 lease accounting, or like I said, it doesn't and it kind of stinks at it, and you have 10 leases or less, we feel that 10 is kind of the magic number, you're in luck. We think that the software might not necessarily be for you, especially if you have leases that are simple and straightforward. You're leasing a business office, right? It's a fairly straightforward lease. There aren't a lot of changes to it. There certainly aren't a lot of frequent changes to it. Excel could do what you need it to do, but like I said, make sure that there are controls in place on your Excel files. The last thing you want to do is fat finger something and it throws everything off, especially if you built an amortization calculation into that. Any solution that you have, regardless of where it's from, should have controls around any sort of data that's being calculated. The big thing is this impacts the balance sheet. Do you trust Excel calculations in your Excel file to the balance sheet? If you don't have, or if your accounting system doesn't do 842, or if it doesn't do it particularly well, and you've got more than 10 leases, we really think it's time to consider a software solution. I'd like you to consider ours because we think it's pretty nifty. We like to think that it's simple to use. That's why we named it the way we did. We think it's time to consider that. And we look at it from two sort of perspectives. The first is being that the cost is more than likely going to be offset by the fact that the journal entries are going to come out correctly, right? One of the other things that we've learned over the last 2 years of implementing this is that the disclosure report is there for you. It comes out, it reduces your time. So the cost of the software is offset by the time savings and the peace of mind of knowing things are being done correctly. And beyond that, a lease accounting application can provide things around control that any auditor, like the other folks on the line with me today, would agree are much appreciated and much needed items in any software these days. You also get an audit trail and workflow and all of these sorts of fun things. So again, 10 or more leases or software that's not too swift as far as 842 goes, time to consider software. So what it is, we're going to give you a couple screenshots and talk through what simpLEASE does as far as handling these things. Because what we have to do is we have to consider that leases coming on board need to be determined and classified as either a finance lease or an operating lease, or even a lease that doesn't qualify under 842 to go onto the balance sheet. Right, so what we did is we built simpLEASE accounting. It's all web-based. It's built with a group of CPAs, so we know that the back end is doing the calculations appropriately. And what it does is it stores all the information about your leases in one place. It assists in classification, and most importantly, it generates journal entries and a disclosure report. So early on slide talked about the changes to the financial disclosure. We'll do all that for you. So simpLEASE can take care of all that. So basically what we do is we walk you through a series of questions to help the system determine, is this thing a lease or not under 842? So simple, plain English questions. We're actually going to ask you 5 questions. And when you get to the end of those 5 questions, we're going to sit back and we're going to record the necessary data about this lease. And all of this information is going to go into the system to help the system determine how to calculate that initial right of use asset, lease liability, and the amortization schedule. So what I like to think is these screens show off the ease or the simple in simpLEASE. This is all about simple data entry points, the relevant bits of data entry, the ability to add more than just the basics so that you can consolidate all your lease information in one place, the ability to classify this along with your existing accounting system so that it's already and set to go for your journal entry export. So if you have dimensions or segments that you report on, include that in the system so your reporting is all set and ready to go. The ability to upload documentation, because when the auditors come in the door, what they're going to want to see is a lease agreement that they can compare the actual accounting to. So this way it all goes into one place where they have the ability to sit back and do a review and do the audit based on all the lease accounting needs. So again, the idea here is simple. Keep it in the system, keep it all consolidated, make the system easy to use because it's not something you're necessarily going to use on a daily basis. Once we've gathered all the relevant data, the system, as long as it's determined that it's a lease under 842, is going to ask another series of questions that'll determine finance or operating for you. So you don't have to look at the things individually. You let the system ask questions, you answer them plain English, yes or no, and it will determine for you whether it's a finance or an operating lease. So again, there's 5 of those questions. Some of them come into play. Some of them are going to ask for outside information. We'll provide necessary calculations. You provide some of that outside information. And at the end of the day, what ultimately ends up happening is the system goes out and calculates an amortization schedule for you. So again, at the end of the day, this lease has been calculated by the system, the initial right of use asset, the initial lease liability, and that entire amortization schedule is ready to go based on what's been put into the system. Now, a whole bunch of other things are happening behind the scenes. You know, we're doing alerting as to what's going on with leases. We're doing reporting as to what's going on. The reporting is there to help you at your month end. Reporting is there to help you when the auditors come out for year end, right? So again, the cost of the implementation and the annual maintenance of a system is offset by the savings you get in having to do all the journal entries and having to do that disclosure report at the end of the year. I have some clients right now that are in the 8, 9, 10, 12 leases kind of category that have told us, you know, this is great. It helps us stay organized, but the disclosure report at the end of the year, it's worth the system. It's worth the cost of the system for that one report, just because of the complexity that we have where we've had to modify 2 leases over the course of the year. So what we like you to do is think about your portfolio of leases, how complicated they may be. Think about how complicated they may be when 2 of them get adjusted, and then think about creating the disclosure, and then think about your journal entry process. You know, those of you that are planning on going and doing this through Excel, there's nothing to think that you're not going to have success with that. But those of you that are undecided, it might be worth thinking about, you know, is a software solution at a reasonable cost worth the time and effort that I would put in otherwise to make all this happen? So with that, you know, typically I would ask questions. I don't know if any have popped up in the chat or anything along those lines. What I'm going to do is I'm going to shamelessly move on a couple slides just because you all don't know me quite as well as you know the other folks on the line today. If anybody's interested, by all means, reach out to me. I'm more than happy to answer questions. I'll certainly defer, you know, accounting specific questions over to Dan and the crew here. But if there's any software related questions, by all means, feel free to reach out either directly or through Dan and the folks online to make sure that you know, you're thinking about things appropriately and taking advantage of solutions and things out there that can help you out in all the craziness that's going on in the world right now.
No, thank you,
Dan,
Jason.
anything
I
else
appreciate that. I think one of the things that I think we really like about the software is we know it was built from the ground up for this purpose. So it wasn't a software that was already out there and was kind of customized to make it work or designed by maybe a non-accountant. This was designed for this purpose from the ground up. And I think that's one of the things. And in full disclosure, I haven't looked at 10 other softwares, but from what we've seen, this one was built from the ground up for this purpose, and it serves that purpose. And that's the purpose it's here for. So it does a lot. I think it does way beyond just the accounting, and it takes a lot of the, I wouldn't say a lot, it takes the thought process of some of the things that Tim walked through earlier that I think can get pretty complex as you start going down the route of trying to figure out all your leases. So I appreciate the presentation. I know we only gave you about a 20-minute or so slot that is probably normally an hour plus presentation. So I appreciate you getting through that so quickly for our audience.
Not a problem. I appreciate the time and you guys all having me here this afternoon.
And with that, I think that about wraps it up for us. So thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out to one of us. We'd be happy to assist. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. Thanks again for joining us, and enjoy the rest of your day. And have a great holiday weekend.